Everyone can take a seat. I'd like to get started. This is a very diverse panel in terms of how they can help you get money or find money. Really, it's probably the most diverse panel that I've seen since I've been moderating these panels. So I'm going to let. I don't like the approach where we go down the line for questions and have 5 answers to the same question. But something going on here. But I do want to give everyone on the panel. Switch it up. What is on? A lot of feedback. But I do want to have everyone get a chance just to introduce themselves and explain how they are connected to helping you get or raise money. So let's start with Greg, please.
So my name is Greg Cullen. I have, I'm not part of an angel group or anything of that sort. We have our own capital, and we typically invest in projects, companies, and things of that nature where they are early stage and where we have some level of expertise. Most of the time we don't invest unless we actually take a significant role in the management of the company. And my personal philosophy about investing is I don't invest in anything that in the event that the founders or sponsors get hit by a bus, I can't step in and take over and manage. That's a simple answer.
Mark.
Well, I'm Mark Deschenaux. I basically specialize in raising money for companies, from startup to public companies. My expertise is mainly in the going public process, who basically try to develop a venture capital arm. We are investing in all companies, and we are very different from what Greg just described, because we don't involve at all with the management unless we basically believe that we can have some added value.
Mike.
I'm Mike Donahue. I'm president of Columbia Capital Securities and Columbia Capital Advisors. My career for many years was as a corporate securities lawyer doing capital transactions, public offerings, private offerings, M&A transactions. Then I started a consulting company which is Columbia Capital Advisors, and we advise companies on raising money, on helping them improve their business plan, improve their materials, and a strategy for raising capital. And then Columbia Capital Securities raises capital for companies. We have 2 specialties. One is life sciences, and the other one is media and entertainment. And but we have people who are generalists and can do work in any area. Software is a major area. Most of what we do is middle market, but we also have a specialty of working with very, very early stage companies and helping them find an underwriter to take them public. And so that's we just closed a $30 million financing last week for a company that's a startup. So we can do startups to middle market.
Gene.
I'm Gene Massey with Media Shares. Media Shares is not really an investor, and we're not a brokerage. What we do is we consult with companies that need help when they're doing their capital raise. We help them prepare their documents and look at their business plan. The last company we worked with, we took a board seat and functioned as a corporate secretary. In general, just help a company get their materials and company ready for an investment, and then we introduce them to investors, people like Mark, who's been a friend of mine for 20 years, people that can invest in your company. So that's what we do.
We're down to the end. Janice.
Hi, I'm Janice Orlando, Pasadena Angels, and kind of a little different niche in that we're very agnostic with our investments. There's about 110 members in our group, and one of the big trends in the industry has been a big change in terms of syndication with other angel groups. So what you'll find is that once you get into an early investment opportunity, even if it's a small amount, we'll oftentimes bring in multiple other, Tech Coast Angels or Sierra Angels, or it just depends on the diversification that the actual founder needs in terms of expertise. We don't need to know a lot about any one industry because we have such a large group of people to draw from that there's usually some sort of expertise in any industry vertical that might show up. And and then there are many of us in the group, like we have a small venture fund also outside the angel group, so there's many of us in the group that also have additional sources of investing once we get, visibility. So happy to be here.
Great. So one of the key things, of course, when you're looking for money is to not waste your time or necessarily even the time of the people you're talking to who in areas that they don't invest in. Try to find a funding source or somebody to assist you in a funding source that knows your area and likes it. We have, and as we just saw on the panel, Greg, Janice have funds. Mark has funds as well, right? So 3 of the panelists actually have the funds to put in. We have others that facilitate. Mike as an investment banker to help actually raise the money. Gene actually helping you position your company to raise money, and then he's of course got a wealth of contacts. So as I said before, a very diverse group on the panel. So very quickly for the funding source people, tell us 1 or 2 or however many you want, but 1 or 2 very quickly, kinds of businesses, companies, not companies generally, don't tell us about management, this and that. What kind of industries and businesses excite you right now? Greg?
I think if I was going to describe what excites me, as opposed to a business, it's probably more of a concept. I like simple businesses. If you can make a widget for 50 cents and sell it for $1 and there's a big market and a lot of demand and you got intellectual property rights, that would excite me. It might be easier to kind of share what doesn't excite me. And those are things that are highly technical, internet-based, computer-based, things that take very specialized skill sets, and it's usually in somebody's head, or it revolves around the founder, and if the founder goes away, the company goes away.
Janice, I know Pasadena Angels is agnostic and does a lot of, what would interest you? What kind of company would interest you?
What I like to see is a business model that's disrupting something that exists and something that's old and needs disruption. Because the hardest thing, we see so many ideas come to us, and oftentimes the ideas are they'll have to convince their customer that they need them. And that's like the worst thing that we want to hear. We want to know there is a customer base and all they need is a better solution. And so I love, like right now one of our companies is solving a tax problem, for instance. Well, that's about as uninteresting as day is long, right? However, it's everybody's problem in every country in the globe. So if we can automize and create efficiency in something that solves everybody's problem, then we have a real huge TAM that's very interesting.
So Mark, you wear 2 hats, but tell us the hat where you actually would be putting money in, or your group would put money in. What would interest you today?
Well, we are interested in the entertainment industry, and we are also interested in companies that have something unique and proprietary. So either covered by a patent. Somebody was just saying before that in terms of a new technology or a field that needs disruption. And I think that a lot of people now, because it's a very trendy name, talk about disruption, but very few companies are actually disruptive. Because to be disruptive, you have to have also a market share. And that's where usually they can't make it.
Okay. Quickly, I'm going to go down at least ask a few people. Do you invest in or work with pre-revenue companies? And if you invest in, what percentage of your deals are with companies that do not have revenues. Greg? First, do you invest in pre-revenue companies?
The answer is yes, but it would only be in the circumstances where the revenue stream seems highly, highly, highly likely. And the steps to get to that revenue stream are pretty clear, definable, and accomplishable.
Mark?
Answer is yes also, but I think that it's always a challenge in terms of valuation, and I cannot give a rule of thumb on how much we would take in such a case. We basically have about, I'd say, 30% of our clients in a pre-revenue situation.
Mike, you're an investment bank. I'll give you a chance. Do you work at all with pre-revenue companies?
We do. Our model mainly is middle market, and that's what a lot of our people are mainly interested in. But we do work with several pre-revenue companies. I just mentioned that we closed a $30 million financing last week for a pre-revenue company. And but that was a very, very special situation. The management team were very, very big players in their field. And and what they're going to be doing is going to be hugely, it's going to be very big. And so that's, and we've got another one we're working with, which is a startup, but it's going to be potentially, they claim it's going to be the most ubiquitous personal technology in the universe eventually. And so that's how big it is. And so we can do, and I'm working right now with a pre-revenue company, but they are ready to commercialize. They have very, very powerful software and a really, really compelling story of the need for it. So,
Are those two companies in the life science space or
no,
not?
that one is a software company. It's It's an enterprise software tool that can help IT managers running enterprise software cut their costs in half. So that's a real simple little.
Gene, I'm sure you'll work with companies like that,
A
right?
ton of them, and it's very unfortunate because a lot of a very early stage company, they don't even know how badly they need help most of the time. They'll think a corporate secretary is somebody that's there in the office answering the phone. The board member is a couple of their friends, and so they really need, most companies that are pre-revenue or very early stage or really need an awful lot of help. I worked last year with a company that's pre-product even, and I spent a year introducing to people, and they kept saying, well, we're coming up in a couple of weeks, we're going to have the product. And a year later, they still don't have a product. So it can be a very serious issue if you don't really have something that can go fairly quickly and is easy to understand. If you are pre-revenue, if there's some way you can convince them, as Greg says, the avenue for revenue is very, very evident. It's very easy to understand. I can see that's going to make a lot of money. Yeah, we'll talk. If it's something difficult to understand and you don't really see the light at the end of the tunnel, it's very, very difficult.
Okay, now I'm going to try to see if I can get an actual answer to one part of my question. Janice, Pasadena Angels will invest, I know, in pre-revenue companies. What percentage of Pasadena Angels deals do you think in the last 12 months or whatever period are pre-revenue?
Pretty small, actually.
Yeah.
Maybe like 10%, 1 out of 10. And the circumstance that I was going to add is probably two circumstances where we would do that. One is if the product is actually being adopted by users on a free basis, so that we know there's some sort of possibility of conversion. So in the event that it's being used, and even if it's not monetized yet, and that there's wide adoption, that would be one circumstance. And the other would be like in the life science or bio business, where the actual, whoever the founder is and the team has incredible experience in actually scaling companies and building out product, then we might invest on pre-revenue basis based on their experience, and that's who we're actually investing in, is the founder. So those are the two examples, and not many, because most companies can get revenue pretty quickly, even if it's a small amount, if they're dealing with it. And even B2B businesses can get revenue on a pretty short basis.
So Mark, what size investment does your group typically make?
We like investment north of 10 million, but we also go into much smaller investment. Like recently, we just closed one for 3.5 million in a pre-revenue company. But usually, it's a question for us of cost, and I would like to just add something to a previous comment,
Okay.
which is I encourage people here who have a pre-revenue company and who are trying to raise capital to go and visit Gene. I'm not making advertising for my friend. I'm just saying that a lot of companies don't know how to structure a deal for an investor. When you usually, and I just would like 30 seconds on that, when you basically invest in a company, you want to know what time horizon you're looking at. And not everybody is just willing to adopt and to enter into a religion to basically follow whatever the guru or the entrepreneur of the company says. We all, as investors, want to know what is the time frame we are investing in and where is the exit. And what I was shocked at is that most companies that are showing us a business plan or private offering memorandum or whatever do not include that in their documentations, and that's why we turn down most of these deals. It's because we don't see what's the deal for us. Sorry to have taken too long.
No, that's all right. So I'm going to try to come up with a harder question. I'm going to posit the assumption that you are presented with a company that is an industry that you like. You think it's a good industry. It seems to be a product that is innovative, maybe disruptive. The company actually is on the either has some revenues or very close to revenues, taking away all those easy outs. What is it about the company? Tell me the main thing that you find when you say, I don't want to go forward. What is it about that company that you have that preliminary meeting, it sounds great, at the end of the meeting you're saying, I like the business, they're doing well, but we're not going forward. What is that thing? Why don't we start with Greg?
Just one thing?
Well, you can do one or two. What kind of things turn you off, so to speak?
Probably, I'll put this in the category of personalities and fit between my beliefs, philosophies, et cetera, and the person I'm investing in. When you spend time, at least because we invest in earlier stage companies and we anticipate getting involved, it's important that you actually like each other, you get along, you think along similar lines. And sometimes it's an oil and water situation and it's not going to be fun. So I would say that is one element. The other element I find that probably causes most deals to fall apart very early on is the entrepreneur, again, because we're fairly early stage, there's no defined metric for how it should be valued. And most people look at, Uber or, something like that and say, look what they're worth, right? And so therefore we're only 10% of Uber. So we're a good deal. And I think their expectations of the real value they're bringing to the table are highly, highly overrated. And this is where you get into the whole valuation discussion and do we get along? Because oftentimes that's where you find out that you're on two different pages and the gap is so big you're not gonna bridge it.
Mike, an investment banker, what would cause you to back away from a chance to make a big commission on a big raise, other than the fact that you don't think it's going to happen?
Right, and that's it. Well, first of all, are we going to be able to raise money for this? That's and it could be a very good deal, but it's not something we could really help with. So that's one thing. But the most important aspect of any deal is the management, and like the other panelists pointed out, is are they going to be likable? Are investors going to like them? Are investors going to trust them? Do they have a realistic view of what this is going to involve and a realistic view of valuation? And If they are not gonna, if they're gonna be difficult and to work with, and investors are gonna think they're being difficult to work with, that's gonna be a problem. But the other major important thing is, do we see a really, really clear path for this company generating tremendous growth in the near future? So that's the main thing to look for.
Janice, same question.
I would ditto a lot. It has a lot to do with the founder and whoever is actually leading the cause. You know, I talk about the jockey being the person that we actually invest in, and I would say that's a huge part of it. All things being equal, if the person leading the charge can sell their product and they can go to market and be their first biz dev guy or has a second in command, then you have more confidence. So that's a huge factor for us. For me personally also, yeah.
We hear a lot about crowdfunding, and is this a good and viable alternative for an early stage company? And we have an expert on that. Gene, you want to tell us a little about crowdfunding and what kind of company makes sense to think about that?
The best chance at getting crowdfunding are dependent on two things. Number one, you have a product that everyone looks at and goes, wow, that's cool. I'd love to have one of those. You know, an electric bike that flies or something, you know, something unique and new and different that really looks cool, and you'd love to have one of those. Because whether you're doing equity or debt, whether you're doing Kickstarter or Start Engine, you can offer that as a perk for either an investment or a donation. So if you've got a really cool product, that's half of the issue. The other half of the issue is your marketing budget. We helped a company with a Broadway show that failed miserably on Start Engine because they didn't have a dime to market. And it was a cool show, you know. We invested ourselves in it, and we're still doing it, and Mark's going to help us with that. But it didn't succeed on Start Engine without a marketing budget. You're going to get between $5 and $15 in investment on Start Engine for every dollar you spend in marketing. So if you've got a $10,000 marketing budget, you can expect to get anywhere from $50,000 to on up. So you have to have a marketing budget. You have to have a cool product and a marketing budget. And then you have to tell that story really well and very quickly, because on Start Engine or Kickstarter, there are a lot of deals on there, and people look all over there and, oh, that looks cool, that looks cool. So yours has to really stand out, and you have to tell your story well. So a cool product, story well told, and a marketing budget.
Good, interesting. Look, a lot of the entrepreneurs in the room and people with early stage or even revenue companies are founders, and they bootstrap the first part of the operation, and then of course and maybe raise some money from family and friends, who are of course family and friends, and who knows what valuation they're willing to give because they're really investing in the person. By the way, everybody else invests in the person. They just do it a little more objective manner. All these people invest in the management team when they invest or do deals with them. But a concern that the founder has, of course, is I sell the company, or I sell control of the company, or even close to control. How long will I be there? And one of the things to do is, of course, have an employment contract. When you invest, Greg, Janice, Mark, when you invest, is it typical for the CEO to have an employment contract? Do they put one in place when you invest? Do you like to see that, or is that a negative, or what? How do you look at that?
Well, first of all, I would say that we basically try not to be in a majority position when we invest. We try to leave the company as it is as much as possible. Also, we do issue recommendations, especially about CFOs. I think that most companies make a big mistake in not choosing a CFO that has already been through a complete investment cycle up till the IPO or up to whatever exit the company has planned. People tend to take somebody who is unexperienced or that is experienced like administratively as a CFO, and I think that's a big mistake. So because we are not in a majority position, we don't have the need for an appointment contract. Also, there is one thing I'd like to ask. We like to invest in entrepreneurs who can sell and who are also humble. I believe that this famous statement that says ego is not your amigo is really something that a lot of entrepreneurs should look at, because a lot of people come to us and say, we are the next Google, we are the next Uber, we are the next thing. And I say to them, you're telling me now that you're the 1 in 10 million. How does that look?
Greg, Janice, any views on employment contracts?
I think it's an interesting question. I've actually never invested in a company where the key people had employment contracts, but I think that's more a function of the fact that we get in early enough. We try to regulate behavior and the future of the key people through stock incentives and clawbacks, which is different than an employment contract, but it tends to have the same outcome.
We're in the same boat. That's what we do. We make sure that the stock, the shares, regardless of what status the shares are in, that there's a lot of clawbacks, that there's agreements, and that the people running the show actually have the majority of the shares. We want them to be highly incentivized to see this through. And regardless of 3 or 4 more rounds of funding, we want to make sure that they're going to be in for the long haul if that's who we're betting on.
You see, as counsel to these companies and ergo the management teams, one of the big questions they have is, even when they don't sell control, how do I know that this investor is not going to come and boot me out in a year if they don't like it? This is my baby, so to speak. And obviously by the way, employment contracts, I draft many of them. They should all be terminable by the board, period, end of story. The only question really is severance compensation. It isn't that you have a lifetime employment gig. If they should all be terminable at will by the board.
Is it okay to have a golden parachute thing?
That's the severance, right? I mean, that's really the only question when you get to employment contracts is there severance and how long? But you raise an interesting point, Greg and Janice. If management comes in and management owns 100% or 80% of the stock, fully vested because I've been at this for 2 or 3 years, when you come in, do you make them redo that and put vesting on so that they're incentivized to stay when you invest? I see Janice shaking her head, yes?
That pretty much, that would be almost a deal killer, depending on along the way. If they're fully vested, they've been doing it for 5 years, and they'd have no incentive, once we do the funding, to stay with the company, that would be a problem.
Greg?
We have not done that. I guess we just, I think if we felt we needed to do that and the commitment wasn't there to stay on, it probably would be a red flag and we may not invest. I've actually never had to go back and do that with the people I've worked with.
Mark, and deals you do, does that come up at all?
Same as Greg. Basically, if we don't feel commitment and if we don't feel that the people are here for the long term, we just don't look at it.
This is the inverse, by the way, of am I going to remain as the CEO for several years? A lot of investors are very concerned about management checking out after a little while, particularly at a very early stage company. It's really 1 or 2 or a handful of people are doing that. If things aren't going well after 6 months, maybe I'll go do the same thing in another company, or I get a great job offer, I'll move on, and an investor says, wait, I just put my money in, why should I, what's to keep you, you're doing the company's going around okay, but some company in the same business comes and says, hey, come be our CEO, we'll pay you $350,000 a year. Oh, that sounds pretty good.
And it's not that we want to tie in that person who wants to move on, it's that we need to have the shares back so that we can employ or bring in the other team members need to fill that spot, and they need something to incentivize people to come into the team, especially at the high level executive place.
Okay, one of the big questions that anyone who is trying to raise money faces, particularly when they've not gone through an institutional round of any type, and they're either pre-revenue or early revenue is what's the value of the company. We've already heard some panelists say that, you know, one of the biggest things that they don't like is somebody with an inflated view of their company. Hey, you know, I'm in an Uber, I'm the Uber of this industry, and if Uber trades at, you know, which hasn't made any money, but the value of umpteen $1 billion, and I'm a startup, so let's take, you know, let's take 1% of that, and I'm worth, you know, $175 million, because it's the same business, just in a different industry, and it's disruptive. You'll find, by the way, when you go out with a 20 or 30 or $50 million valuation, you don't get a lot of interest. But that begs the question: how do you value that company, and how do you think about it? Greg, how do you think about that in terms of helping people when there isn't the normal metrics of revenues and profits to value the business? And is there sort of a standard range of valuations that seems reasonable based on the level that you're going to invest and percentage of company you're interested in, et cetera?
You know, early stage pre-revenue companies are really tricky because, you know, just like in the real estate industry, you'd love to have, you know, 4-bedroom, 3-bath homes all lined up on a block, and you could say the last 3 sold for this, so this is what mine's worth. In the world today and the businesses I look at, they're all so very different. And invariably, people do point to, you know, Google and Snapchat and Twitter and all of these things and try to justify their valuation. I think it's more a discussion, a negotiation, and the reality is, with the entrepreneurs I've dealt with, if their projections are really realistic and they really believe them, even if they take a small valuation now, if they actually get to the finish line, they're going to be worth tens of millions of dollars, typically. And that's what they're presenting to me as an investor. Look, my company's going to be worth $100 million in 5 years. Well, 20% of $100 million is $20 million, and they're looking for money now, so they don't have money. So that's a great win. And oftentimes people get hung up because they want to keep 80% or 90% for control reasons, or because they heard of somebody who did this or that or the other thing, and that means that they should get the same valuation. And I think the more important thing is getting into the end zone. You know, if you stay on the 10-yard line or the 20-yard line the whole game, you never get into the end zone. You don't win the game. And so many people fall apart, and company ideas fall apart because they're so fixated on valuation. And I'll share just briefly a short story here. In 1996, I came on as a CFO, 1995 and 96, of a fabulous, fabulous, fabulous company who had patents in the personal watercraft industry. Fabulous product, great market acceptance. We were trying to raise money. And he was so hung up on control, I saw him about 6 months ago. 20 years later, he's still raising money for the same company. He missed, I mean, regulations have changed, new products have come, his 16-year patents have lapsed, and he's still trying to raise money. He never got off the starting block. And if he would have discounted his valuation 20 years ago, actually it's 22 years ago, he would have had money. And he's in a $2,000 a month rental garage, still trying to get the same thing off. And most entrepreneurs don't think of that outcome, but that's probably 9 times out of 10 where most entrepreneurs with lofty valuation goals end up, is sitting around forever and ever while the world passes them by.
Okay, I didn't hear any numbers there, and obviously we're talking to the abstract. Janice, you got from the Angels' perspective, there is sort of a range typically for these kinds of companies where if you're out of that range, and obviously there's exceptions, it's sort of you're out of the range, and can you talk about
when
that?
you apply to our organization, we kind of have a reference point that if you have over a $10 million valuation, we look sideways a little bit because it doesn't really fit in our early stage startup, the amounts of money we're raising. So yes, we have that, and we have invested in, and I've personally invested in companies that have much larger valuations and have a small piece of it because I see the upside, right? But in terms of just the angel world, there are some valuation caps. Now, we looked at 3 deals in this last month that were 20 million valuations, so there are exceptions. You're talking about as a rule. As a rule, anything under 10 million seems kind of reasonable in a very early stage investment. So I hate to put it in a box because there are exceptions, and at the same time, what happens if you have too big of a valuation, usually you don't belong in the kind, you shouldn't be raising $200,000, for instance. You know, there's something amiss there. You probably should be raising a little larger money than what we're doing in our group. Now, just 2 cents on that, if you came in with a $20 million valuation and it was well justified, and our group only was in for 200, one of the things that happened in the angel world is we syndicate a lot of transactions. And so then we would reach out to our network, and we might be able to raise the $2 million that you're looking for on a $20 million valuation. So there are exceptions, and we encourage you to, show up in that space.
2 others want to speak on this.
I got
Mark,
a great story.
let's let Mark go first, and then Gene go.
So the first thing I would like to say, we have a very simple formula for pre-revenue companies. We basically invest on 10 million plus the value of the assets plus, and of course, if it's not already in assets, if it's already in cash, the amount that was already invested. So suppose a company had already, let's say, $1 million investment in it. It has a value for its cash, its asset, whatever they are, cash or nature, and basically we add $10 million to whatever there is in it. That's the same if the company had already $50 million worth of assets. Sometimes we see it in real estate companies which basically bought a land in a country that is in development, and that basically this land grows up in value. But to stay focused on this, I recommend a book that says a lot about pre-revenue valuation, which is The Dark Side of Valuation of Mr. Damodaran. That book, will guide a lot of people to making a valuation that makes sense. Finally, what I would like to say is our group doesn't care at all about financial projection, because we think that a lot of these financial projection are plain bullshit. What we basically focus on is the assumption that creates those projections. So when you write numbers, if you write numbers about projection, we are not interested. Make a full development of your reasoning on paper that says how you came to those figures.
Gene, you have a story?
I got a great story, and it's actually about Mark. And I'm going to tell you about an entrepreneur that thought he had something so valuable that he just really thought he was the smartest guy in the room. I think it was around 2000, Mark invited me to the Bel Air Hotel for a very nice, fancy luncheon, and he offered me $250,000 for my patent, which was a business method patent for a new way to finance movies on the internet. I called it fan financing at the time. Now it's called crowdfunding. But I thought I was so smart. I've got this new way to fund things. Everything's going to be funded on the internet, I thought, and I'm the smartest guy in the room, and I did not accept Mark's $250,000 offer for purchasing, and he even said, you know what, you can use it. I'll buy it from you and you can still use it. So thinking that I was such a smart fellow, to this day, I have not used that patent. And now Mark has come to me and said, well, I'd like to talk to you about the patent. Do you think I will take any offer that he makes now?
Who said deals aren't done on this stage?
So, but it's a symptom of a disease that a lot of entrepreneurs have. They think they've got the solution for everything, and they're so smart, they're smarter than anybody in the room. And so that humility is hard to find, and that's one thing I would encourage everyone to take a real hard look at. Is your deal really that good a deal? Because I suffered from my experience of having a big ego, which was not my amigo, and and now I'll take any offer Mark makes now.
I've got $1 here.
Let's change directions a little bit. Many of you have heard of Reg A offerings, sort of a type of IPO. And Mark has worked with those, and Mike as well might know something about these. That early stage companies, or small, early revenue, or maybe pre-revenue companies, going public and raising money simultaneously through a process that provides a market of liquidity for your investor. Mark, you want to tell us a little about Reg A transactions and your involvement in them?
Yes.
What makes sense for what kind of companies that makes sense for?
Well, first, what company it makes sense is a really tricky question because it could be almost any kind of company. The great thing we like about Reg A in my group is that it allows the investor to immediately see an exit or plan for an exit. And I think the venture capital worldwide, not only in the US, is really missing the point of the exit. A lot of people think because they want to again, it's a question of ego, they have a lot of money and they think, we don't need an exit, we can stay 7 years invested. The problem is that most companies don't last 7 years. And other problem is that when you don't have an exit plan from day one, it makes the management disoriented. I think that it is important for us to organize that exit, and Reg A, has allowed us to do that. A Reg A, also it's very often called a mini IPO, is not an IPO, and it's not a full registration statement. And you, Adam, could say a lot more about that than I could, because it doesn't follow the same rules, and it doesn't. It's really a big shortcut, and I think it was a great initiative to have this Reg A plus. But I also think that we have to be careful for the market safety with it.
Mike, does your firm work with companies on Reg A offerings or not?
Well, I'm pretty familiar with Reg A offerings, but we've never done one. The investors we know and the investment banks we work with, they just use S1. And I think a major advantage of Reg A is you don't have to become a reporting company, right? You don't have to do that. And so, but
And you can sell to non-accredited.
right, yeah. But the people we're dealing with, they want to become a fully reporting company. They don't want to get on OTC. I used to do a tremendous number of deals taking companies public on the OTC through reverse mergers, and that was a very, very great tool and successful model until 2008, and since that time, not so much. And we really recommend there's something called OTC Hill, and going public and getting on the OTC nowadays is very, very hard to make it to be successful. And we just, the people I know, they just do S1 and become fully reporting and go right to NASDAQ.
But there have been Reg A's that have gone straight to NASDAQ now. There's half a dozen of them that have gone straight to NASDAQ.
But I don't know the national statistics for Reg A offerings, but I do know on the West Coast they're very uncommon. I think it's much more East Coast. They're just very rare, which again would maybe why Mike isn't involved, because they're just, people aren't doing them as much on the West Coast.
Absolutely.
I know we're over time. But do we have time for questions, Dave, or should we? Or what? I would say one thing is, as you're thinking of your questions, people sometimes talk. People at the panel have mentioned, exits are important. Is important. If you're an investor, the goal isn't that you're in there forever. It's how you exit. Obviously, becoming a public company is one of those ways, but it's not the typical way. When should you start exit planning? You should start exit planning from the day you start your company. That doesn't mean you're hiring a lawyer or an investment banker or somebody to find a buyer. It means that you need to position your company to exit at any point in time. Again, as a startup, early stage, you're not devoting much resources to that in particular, but as you grow, as you get into revenues, you should regularly think of, how am I going to exit? And am I in the best position to exit? The mistakes you make in that process leading up to that do one of two things. They will decrease your valuation if you're going to sell out on a private basis to a company, or they may make a sale impossible. You may have contracts and things like that that are so difficult to deal with, or an investor group, or a way that you can't even, with control, sell your company. So think regularly about exit. Is your company have you maximized the value of your company? Have you put yourself in a position that when anybody comes in, they don't have to worry about the sloppiness that you've done in record keeping, bookkeeping, financial records, other records, that your contracts were, hey, I just wanted this contract. Oh, wait, I can't transfer this contract. I can't transfer this company without my contract being terminated, and it's a key contract. Now my whole fate is in the hands of the other party. These are really critical things. Don't overlook them. You should be prepared to exit at any time, even if it's 5 to 10 years down the road. So now let's open for questions.
On that theme, one of the main things you find in investment portfolios is, here are our successful exits. If we got an exit, that's very successful. We got a first question to be asked when you're getting in, how am I going to get out? Okay, we have certain rules for questions. Number 1, don't touch the mic. Number 2, short questions. Number 3, short answers. Number 4, don't touch the mic. Saul is in charge. If you get to raise your hand and you get his attention, he'll come over to you. Where's the first question? Right here, is the man.
Thank you. My name's Alan Stone with Wall Street Research. My question is addressed to Janice. According to your background, you've invested in 30 companies, early stage companies in your personal history. Maybe you can give like a synopsis of like what were the top 10%, the top 3, and what's your overall return on investment experience been on those 30 companies? Has it been a good payoff for you?
So I've been officially investing about 8 years in other people's businesses. I was a serial entrepreneur before that, so it's been in that period of time. I've had 3 exits in that period of time, and there's about 3 pending right now. So I'm not sure I'm a great person to have statistics. I only one company I think is in trouble, so I'm very lucky, because most people have, failures faster than that. So I don't really have a statistic that I think is meaningful. In the angel investment world, what was the percentage question you asked was?
So you had 3 out of the 30 that exited?
Correct, yeah. One was a 2.5, one was a 5, and one was a 10x. I was very lucky. Well, it was actually 12x, so for me that was a great win. Yeah. Right, and like I said, I haven't had any that have failed yet. And, some are struggling. But one of the things that we do, that my investments do, is I ask for exit plans every 6 months in writing from the founder. And it gets renewed, and we have the meeting, and I meet with them personally. So I'm really all about, the focus of the team. And so, I don't know, that's just part of what we do.
Another question?
Not touching the mic. Hi, my name is D.W. Farrell, and my company is Localism, Inc. And my question is, with our first business model, we did over $500,000 and then realized, wait, we have another opportunity here, and pivoted. And so I don't feel like in our financials we can include any of that as traction or revenue, because it's just not at all the same business model that we're putting together as a package for investors going forward. So I wanted to ask if you would recommend including any of our previous business model numbers. My sense is, since it is the same audience, but it's a different model entirely, it really isn't a direct correlation. It's not a demonstration of traction. But maybe there's a way to say, we actually did these numbers in the same market. What's your thoughts on that?
I'd vote for you because you pivoted. See, you had the sense to take, say, wait a minute, we need some changes here. And did you say that you had some success previously, but you saw then and still pivoted? Am I correct in that?
Did 600 gross revenue, but our
And you
costs
wanted
were
to do better than that. So you had some
Right.
revenue, and then you decided that you wanted to pivot. I would vote for you
right,
because
but
you
it wasn't
pivoted.
scalable.
Okay, see, I would, because you changed and you upgraded and you said, you know what, we're going to go do this now. I think that's a vote of confidence.
Other questions? No? Okay.
Yeah, I was in Rotary Club, and you never grabbed the mic, so I understand. First of all, thank you all for your comments. Are right on point. I really do appreciate that. As an entrepreneur, a serial entrepreneur, having achieved all the success you have, congratulations. I would love to have any of you talk to me about my company and any advice. I have my ego totally in check. I think I have something exciting to offer. If you want to contact me after this meeting, I'd be more than open to speaking to you. Thank you.
Over here.
Hi there, Jeff Hall. I'm the guy with the news aggregator. Today we talked about these B2B news feeds, which it's good from a business perspective. But the thing that people most like about our site is this idea that we are politically neutral at a time when our country has become so hyper-partisan. And part of me wants to break that off as a separate entity and maybe do crowdfunding for it, because people think, God, if you're going to go into the news business, you're up against the giants, and how can you possibly break in and compete? And yet, people love this thing, the idea that we're politically neutral, and show, you know, how Fox News, Huffington Post, BBC, CNN, how they're all playing the same story side by side. But I've also heard at these panels in the past that if you do crowdfunding, then you lose your opportunity to raise money from angel investors or venture capital people later because they think your cap table is too messy, et cetera, et cetera. I was just wondering if anybody could give me any advice on the political side in particular, how to best proceed with that, because I actually think it's a winner.
Well, the first thing I would say is that a lot of companies try to do crowdfunding and something else. So not do it at the same time is probably a good idea. Now, the problem is that if you do crowdfunding and later investors find out that your crowdfunding was not successful, then that can be a problem also. And crowdfunding leaves a lot of traces on the internet. So usually, if they want to know that you did crowdfunding and failed, they're going to know it pretty easily due to Google and search engine and other things. So what I would recommend is not do both at the same time and start by something else before doing crowdfunding.
Hi, Christina Brujon. Question for you, and I didn't get a chance to mention this, but with our investment raise, we're looking to give and entice a piece of equity with the parent company. And so my question for you is, does that make a difference in how you approach an investment and your participation after that investment? Do you find yourself participating more in the management? And just a question of, if we offer to be fully transparent with everything, how much would you want to be involved and how much should I expect from an investor in terms of participation after the investment? Sorry, just a quick clarification. To ensure those 5x, 10x, 20x exits on your investment, what do you do to shepherd that process? Does that help clarify?
First, I would say what I didn't like in what you said is that you said with the parent company. I think if you raise money, your cards have to be all at the same place and they have to be laid out on the table. I wouldn't want to invest in a company that basically has a subsidiary where if we do something to raise money, all cards have to be at the same place on the table, especially in a pre-revenue phase.
I would second that. if it's not all in, we're pretty much not interested. You know, you got to be, because interests are not aligned at that point, maybe. So you're talking about raising equity, and then your question is, how much do we want to be involved? Early stage, we often ask for a board seat. Sometimes we always ask for information rights. We want to have quarterly financials. So, you know, we're not intrusive. We don't think it's intrusive. Some entrepreneurs don't want to give that. They think it's too intrusive. That's fine. But if we're not like have some sort of pulse on the business, we can't be helpful. And we can actually be very helpful along the way, because there's a lot of legs and hands and brains in the room. So we do like having that kind of input, if that's what you're asking about.
Thank you.
Dave, how many more questions do we have time for? 2 more questions. Okay, I think we have them lined up.
Yes, hi, my name is Bagrat Safarian. I'm co-founder of the company. We created the e-commerce platform. And the question I have, so this is first time we're going out to attract investments. We've been self-funded so far, and some of the convertible notes from, you know, the friends and family types. And I'm trying to understand what would be the right investor to target in terms of angel or venture capital. What would be the criteria to use to, you know, filter what would be the right investor for us? And yes, we're looking for about $2 million to raise.
I'll answer that if I may. I think the right investor is the one who's going to write a check. And when you're looking for money, you got to look a lot of places. To my knowledge, there's no one source where you just go and get money.
Nobody can do your prospection on your behalf.
Okay, we're to last question, right over here.
No, it's okay, it's okay.
Hello, I'm Han. I'm from Expo Portal. We are the blockchain-enabled B2B e-commerce serving for SME supply chain. So I have 2 questions, but it's very short. One is the questions for like investment decision-making criteria. Do you consider women-led or women as the founder of the company? That's the first question. The second question is because you also mentioned that you have like consultants who helping the entrepreneur to do business plan, how to bridge the gap between what they need and what their investor wants. So I would like to know more about what is the cost for an entrepreneur to do it. Get the services from you. Thank you.
You know, that brings up that's an excellent question, because so many entrepreneurs, early stage entrepreneurs, start with nothing. And you have to have some money to raise money. You have lawyers, and people write business plan, you have to have incorporation fees. Everything about starting a business requires some money, and that money generally needs to come from someone that loves you. Because they will give you money even if they don't think it's maybe the best investment in the world. They're willing to take a chance on you because you're their daughter or you're their sister or something, you know. So it's very important that you come up with some money, and that money can be $10,000, $20,000, or it can be $100,000. It depends on what your business is and you also need to show enough of your business where an investor goes, ooh, that'll work, that's great. You know, so you need to have something to start with, and generally you need to find someone to support you in a very early stage. It's called friends and family, and so you want to find someone like that will give you something to get going, because you're going to deal with things like corporate structure and documents and legal fees and making the website for the business and creating a marketing plan and stuff like that, and hiring. Sometimes you may not be able to find enough people that'll all work for free. They got to pay some people something, you know. So those things, the most important thing is to have something to start with.
You know, there's another reason you need to raise money from someone when you start. not only because you need it, but most investors take a look at a prospect, and they want to see that you are able to raise some money from your friends or family or somebody, that somebody else out there trusts you and is impressed enough with you to invest some money with you. And if that's not there, oftentimes the investors get worried about that.
Well, that thunder means it's 10:30 and time to stop. Can we thank the panel for?
Let me say a word from the sponsor here real fast before we thank the panel. April 25 is our next one. If those of you that are interested in presenting, submit your first round by February 15. That may sound a little early, but there's an incentive. Some deals that really look good, we actually put out on our big promotions as somebody that might get met here. So you get not just a few hundred people, you get thousands of people that can look at your deal in absentia. So February 15th is a good time to start. We'll be happy to support you. Now, let me thank this panel. This panel, I've been to a lot of panels, so have you, where the main theme is, look how great we are, and we've done such superb things. These fellows and lady have said, here's how you can get money out of us. And that is the theme of this panel, and they have done a superb job. Alan has done a superb job with the questions. What do you think?